allow me to tune in for another second, please. Um, I want to just give a general update on the market and touch on this anomaly that I just written about in a group chat. And here how it goes. Yes, now I'm completely certain that this move in 2-year was an anomaly connected to money leaving the RRP and moving to money market funds to bid up the bills. My bad. Unfortunately, this anomalous move has completely taken us offside in regard to currency and SOFR plays, and this is what happened essentially. On Thursday, on that day, and that's Thursday, January 6th, we received the CPI report on 3:30. That was PPI this Friday. This is core CPI inflation rate, which came in hotter than expected. And after that, closer to the evening, we had this bill auction, 4-week and 8-week bill auction, and maybe that's what caused this incredibly huge drawdown in the RRP when money went fast into the money market funds, bidding up the 2-year USO 2-year, and even though inflation came in hotter that day, this move in 2-year was very counterintuitive, and dollar at that point, initially, as we've been trading the dollar, it moved in the right direction. It moved as it's supposed to, right here. And then, because of the algo's normal correlation, when the 2-year does that significant dip, essentially the whole surface shifts with the 2-year. 2-year drops, and everything that is positive and anti-correlates to the 2-year moves in its given direction as well. And that's why Dixie, essentially, with the hotter CPI print, just all it did is consolidated and more, and off we went. This is what we were expecting to happen on Thursday, Friday, after the hotter CPI print, but the 2-year moved completely caught us off guard right there. That is all well and good. The other mistake that we made is, well, we've never seen this breaking correlation, and we just couldn't understand it. But Citrini played it perfectly, and we, unfortunately, I just ignored this. But that was a great, if you remember, we were short SOFR futures right here at 95.8, expecting the whole CPI print, just generally better than expected economic data, unemployment economic data, high frequency economic data coming in, and therefore we just normally had to dial back those cut expectations, right? And this move should have happened right here, and the economic data came in brilliantly, just as we expected it. We just received today the retail sales print. Retail sales print beat the expectations once again. Economy is resilient. The consumer is resilient. Is stronger. There is no slowdown, or maybe partial slowdown, yes, but not even close to recession in Q4. So this is what should have happened, but. And Sid essentially shorted it at 96. He put on a fly right here on that day. He put on the fly, which was absolutely brilliant by him. His timing is, as always, impeccable. He shorted fly, shorted March 24, went long March 24, shorted 2 of December 24, and went long the December 25 as well. That structure gives you a fly, produces this type of chart, and he essentially went long it, and playing the transfer of the cuts that have been already priced in 2024. Incredible amount of cuts, 150 basis points of cuts, and a 70% probability that they're going to cut in March, which was too much at this point. And we were short September SOFR futures, and we should have re-entered on that day as well, because the expectations were absolutely out of line. But we didn't know what this was connected to and how far this move can go, because just no understanding. We just should have tried to enter this with a tight stop. Anyway, so this is the blueprint. Once again, as I've outlined just in a previous video and a post, On the trade basis, direction is clear. Dollar is moving up, rates are moving up before the FOMC, and the FOMC and the QRA will absolutely decide the fate of the dollar and everything else in regards to where we're going. But I'm pretty sure the Dixie is going to 104 at least. That is clear, and the SPX. Once again, as we've been saying, do not be fooled by these moves. This is not a beginning of a significant move in either direction. We will most likely be in this tight consolidation with going up and going down, going up and going down. So how are we playing this? Once again, we've put on a lot of trades, especially today. We outlined the Tesla short, we outlined the UTI long. This is, by the way, on SPX. If you think that on the 31st, on the FOMC and the QRA, let's say something interesting will happen, something positive will happen, and the overall this would be a positive catalyst, meaning the worst thing that can happen with FOMC is that they just cool off the market expectation a little bit, sound more hawkish, and maybe we just price out the March cut entirely. It's not a significant movement, it's not a change in trend. This will impact the asset classes on a trade basis, but once again, nothing major from that can be drawn from that. One of the crucial points is if they will be asked, or they will be asked about RRP facility and what's going on with the. Once again, this escapes me. Excess reserves, banks access reserves. What's the problem there? Is there a problem there, and what are they going to do with QT and QE? Whether the FOMC is going to be positive or negative for the overall market, I don't know, honestly, because they might sound hawkish, but at the same time say that they're going to restart QE or maybe taper the QT, so this maybe just counterbalancing act from them. But the QRA is of the utmost importance. If there's, once again, I'm repeating this again and again, but if there's going to be another step function in bond issuance with these conditions, with Goldilocks, with the inflation reaccelerating, and if the Federal Reserve completely omits the QT discussion and doesn't give guidance on that, holy smokes, 10-year should go higher from here, and significantly higher once again. Unless we're missing something, unless they are already introducing some ways of drawing and more liquidity into the system by ways that they hasn't already announced for us for the broader market. That's a possibility. If you think that, then yes, then this is, even today, it's a good opportunity just to get long stocks. Really get long stocks. This is your trend resistance, and with some sort of deviation and variance in price consolidation, and then 5,000. Easy, absolutely easy. And honestly, however the path may be, I think that this is the most likely scenario. Treasury may announce that they're going to draw on their TGA account, and let's say they draw 400 billion this quarter in order not to issue, in order not to spook the market with more coupon issuance. Anything, so many levers that I can pull, but we know their inclination. We know their tone and what they want to achieve and what they don't want to achieve. First of all, the main job of the Federal Reserve is to make Treasury look solvent. This is the only thing they really care about. No unemployment or inflation comes in close in importance to that. And in Treasury, methinks there's a political bias in there, and it's an election year. So many variables play into that. Let's see what the inclination is going to be. So you have to be very careful and play your trades, play your trends before the move, or start preparing for that move, just however you like. But generally, overall, this I've been saying that to preface the UTI trade. On this day, this small cap stock, the flows are incredible. The fundamental case for it is also incredible. It's in the middle of the reindustrialization of American, bringing the industrial base back. They need a lot of workers, plus the problem with not the problem, but the tendency of rising wages in the producer side of the economy, industrial economy of the US, draws in more interest from the people, and people go directly through these guys. I've listened to the latest earnings call, and the prospects are absolutely stunning, incredible, and this resilience, this on this day when the dollar moves as it does, dollar moves so strong to the upside, SPX moves so strong to the downside. This was the reaction from the UTI. No reaction. Long UTI, there's an easy path for this stock to up to $16-18 and even higher. So this is the idea. Another idea. Another idea also is, we outlined this. I already put this on. RTX and LMT, Lockheed Martin. Once again, everything, the most likely scenario that everything that is happening within this region above the key interest area right here will be completely irrelevant before the earnings, which are going to come out on the 23rd. If the earnings come in good, there is a great opportunity. Even if it dips below this, there's a great opportunity that this will actually pop back into 88, 89, and $90. Or so our thinking goes, so our research says. So all of these moves, higher, lower, it don't mean much, honestly. You can't draw any conclusions from it. LMT, same thing with LMT. LMT tends to consolidate until it doesn't move like this, or move. No, that's a bad example. But overall, the asymmetry is here, just complete opposite of Tesla. If Tesla undershoot on earnings, Tesla will get absolutely annihilated. If these guys, if earnings come in good or better than expected, there's a good opportunity for potential for LMT or RTX to move higher. That is one of the trades we put on, and that's it. That's all I wanted to mention.